You're entering the future-ready CNBC-TV18 EBIX Cash Studio.
Hello and welcome to the CNBC-TV18 EBIX Cash Studio. I'm Sumaira Abdi and you're watching MF Corner. Joining us today, we have Devang Shah, co-head of fixed income, and Ashwin Patni, head of products and alternatives at Axis AMC, to talk about what is the outlook now for debt funds after the Reserve Bank held rates steady. What are the kind of funds which are now in favor? So, gentlemen, good afternoon and thanks very much for joining in. Devang, my first question to you is just this, that, everybody expected that the Reserve Bank would hike rates. They didn't. So what does this mean for debt fund investors? What are the categories of funds that become attractive now? And are target maturity funds still the preferred route?
So, yeah, I think you're right that as against consensus, RBI was significantly dovish. If you actually look across at the RBI commentary also, I think they are focusing at this point of time on the growth. And they are saying, if you look at the next year inflation target, they have significantly reduced that. So from a perspective of the Reserve Bank of India, I think the commentary is very focused on growth orientation at this point of time. Most of the markets were actually, because of oil and all the global central bankers turning hawkish, I think the market expectation was that RBI might choose to do some reverse repo rate hikes or probably also look at the stance change. But at least the commentary, at least at this point of time, is that it's bye-bye rate hikes for at least near term, near 3 months or so. Our view is that with RBI being very slow and gradual and the focus entirely being on growth at this moment, target maturity funds, short-term bond funds makes a lot of sense for investors. We've already seen a decent sell-off in bond yields over the last 2 months or so, and specifically since October. Now the entire yield curve is probably 30 to 40 basis higher than what it was 4-5 months back. So we believe that target maturity funds, short-term funds with lower duration makes a lot of sense for investors at this point of time.
Okay, so let's focus on this segment, which is the target maturity funds. Ashwin, for somebody who's looking to invest in these kind of products, I mean, one we understand, of course, is that for a target maturity fund, that, the life of the scheme will sort of coincide with the life of the bonds, right? But what is the kind of credit criteria for bonds over here? I mean, is there something that SEBI has specified? What is the general practice?
Yeah, so basically what happens is that these products tend to be typically passive because you're trying to create a basic index of what asset classes, let's say SDL or corporate bond or GSEC, and within that what issuers come through. And obviously looking at the maturity profile, it gives you a sense of what the portfolio will look like. So typically what we have seen so far is that most of these products are heavily biased in favor of very, very high quality portfolios. So they could be GSEC, SDL, or very, very high quality corporate bonds, typically biased towards more GSEC, SDL in that sense, or CPSE, let's say, corporate public sector enterprises in that sense. So one part of your question, yes, clearly the profile of investors that is coming into this product are those that are looking for very, very high quality portfolio. But also the second part of it, which is that having a predefined index construction methodology, having a predefined sort of a process which is known on day one, there is also a very, very high element of transparency in terms of what kind of issuers will be there in the portfolio, not just today, or also in terms of the going forward over the tenure of these schemes.
Devang, we've seen these SDLs, the state loans, becoming quite popular. FMPs in season, actually, FMPs used to be very, very popular. What is the current attraction now for a debt investor to look at these kind of segments?
See, my understanding is generally traditionally what we have observed over years is that Jan to March quarter is a quarter where you see a lot of credit pickup and you generally see a lot of corporate bond and the issuances, and that was the flavor. You see tightness, but all those things have significantly cooled off. If you look across in the last 2-3 years, financial years, Jan to March has remained a quite a stable quarter. And yes, obviously we had events like COVID. Previously, before that, 2 years back, we had that slowdown in growth on account of liquidity and NBFC crisis. So I think last 2-3 years, we have not seen such a huge jump or rise in yields in the Jan to March quarter. To answer your question at this point of time, our understanding is that a significant realignment of rates have happened. So we were a year back on the 3-year corporate bonds. I think 3-year corporate bonds used to trade between 5.25. Now 3-year corporate bonds are trading upwards of around 6%. So there has been a 75 to 100 odd basis of sell-off already happened in this segment. We believe so that because RBI is going to be slow and gradual, and at least in the near term, we don't expect any major rate hikes from RBI. Investors who are looking at parking for their money for a medium-term solutions, I think target maturity funds of 21, 26, 27 segment or short-term funds at this point of time makes a lot of sense. Yes, FMPs also in ballpark 3 to 4 year segments with an SDL preference or a corporate bond preference makes sense for investors who are looking at medium-term conservative and passive investment solutions.
Okay, Ashwin, what should be an investor's objective for investing here?
I think if you look at any debt investments, there are 2 or 3 parts that investors, want to get clarity on. One is what is the likely return range for their investment. So typically, when you look at portfolio yields, that should give you a sort of a ballpark in terms of what kind of yield range you're investing for. Equally importantly, and especially relevant in this context, is in terms of realization of that yield over the horizon, what kind of volatility that they may see or what kind of ups and downs that they may see along the way in terms of the journey. And as Devang highlighted, what we have seen in terms of the context in the last 6-12 months is a very much a change in regime from a scenario last few years where the rates were falling and there was capital appreciation, etc., available, to a scenario where there is much more uncertainty of how things will play out. We have seen some sell-off already in the last 6-9 months, and absolute yields have gone higher, but there is still a trajectory uncertainty, especially if you have a 12-24 months, which is what a lot of investors therefore are looking at these products, whether you call a target maturity or an FMP, to sort of do away with that potential for any interim uncertainty. You basically come in with a defined yield and a defined trajectory, and that really helps give them a lot of comfort that if there are interim shocks or interim uncertainties, that will not affect their journey or they will not affect their investments in these products.
Okay, gentlemen, do stay on. We're going to take a very quick break here, but we'll continue this chat about target maturity funds, FMPs on the other side. Devang and Ashwin both stay on with us. Stay tuned. Hi, welcome back. You're watching MF Corner. With us, we have Devang Shah, the co-head of fixed income, and Ashwin Patni, the head of products and alternatives at Axis AMC. And we're talking about some of the segments, from the debt side, which are in flavor, whatever you call it, target maturity funds, FMPs, etc. Devang, between FMP and this target maturity fund, the only difference I could understand was that one is open-ended, one is closed-ended. I mean, what is the preference here for a retail investor now?
I think what, as Ashwin highlighted, I think the target maturity funds, the important aspect is that there is a lot of focus being given on the constitution of the index. And you get a full replication of index, which is done at most point of times. So you know what you are investing into, you know the underlying securities, you know the majority of the papers, the probable running YTMs for the security. So I think there's a lot of information and a lot of awareness of these products available into the markets. So target maturity funds are probably a clear substitute to passive investment solutions. So as against FMP, where FMP is probably is just I would say a close-ended fund. You get there is no reflection of portfolios. There is no a carry accrual being mentioned at all point of time. So a target majority fund is more open-ended FMP with complete disclosures on portfolios and the underlying securities.
Ashwin, this target maturity fund, if somebody is looking to have it in their portfolio, is this more of a lump sum investment? And, would investing in the nature of an SIP defeat the purpose here?
Not really. I think that's the beauty of an open-ended structure, that it can work for people with different cash flow situations. And let me give a simple example that if you make up, let's say, a 2027 target date fund, which is say 5 years from now, and people are allocating because they have a certain objective at the end of it. It doesn't matter. Some people may have a lump sum today. Other people may be contributing over a period of time to get to that 5-year objective. And being open-ended, it gives them a lot of flexibility to, play out this cash flow. Even if you look at it from a market perspective, in a scenario like today, when there is an element of uncertainty about the trajectory of interest rates, we've seen a fair amount of ups and downs in the last 6-9 months, as we were just discussing. There is an element of averaging which can come in as people allocate over a period of time. So yes, the trend is towards more lumpy allocations, but even those investors who want to split it or spread it over a period of time, it still works pretty well for these funds.
Okay. Devang, are there some sort of life durations which are more favored for this segment? I noticed, even you spoke about that 2-4 year bucket, even the 3 to 5 year bucket seems to be very popular. Or is that something which changes with the prevailing interest rate expectations?
So I think probably it is a function of interest rates as well as the absolute points on the curve which look attractive for investors. At least whenever we launch a target maturity fund, the thought process is that at this point of time, the specific maturity looks good on account of various reasons. It can be an interest rate view, it can be a liquidity view. So on various aspects, the segment or the target maturity looks attractive to us from an investment horizon perspective, and hence the funds are launched. Typically, what we have seen is that 3 to 5 year segment is the most popular segment in this bracket, because somewhere down the line in the last regime where we have seen this liquidity being absorbed from capital markets as well as slow and gradual rate hikes, these points on the curve have become significantly attractive, where and 6 quarter, 6 half kind of levels for 3 to 5 year bucket makes a lot of good sense from an investment option perspective. So currently, looking at the interest rate view as well as and from an overall rate regime perspective, I think the 3 to 5 year bracket makes a lot of sense for investors.
Okay. Ashwin, do you notice any sort of change in the risk appetite of debt investors?
I think we have seen by and large a move, and this is something that we have seen in multiple cycles, that every time there is an uncertainty on the rate trajectory, people like to sort of lock in yields, or in the old days, of course, there was no choice. It had to be done using FMP kind of structure. So people use that. Now that we have target maturity products, that gives you a much more liquid option to do that, as opposed to the lock-in requirements of FMP. So from a risk perspective, I think clearly there is a bias towards locking in yields, not being exposed to the uncertainty in terms of the rate trajectory. And equally on the other side, I think there is still a little bit of favor for very, very high quality from a credit risk perspective. So even on that account, as I already mentioned earlier, most of these products, since people are looking at a 3-5 year trajectory, people are much more comfortable allocating to very, very high quality portfolios as well.
Devang, just one last question. And this is something that a lot of people want to know, is that how long might this environment of negative real returns last? Should investors start changing their portfolio positioning? I mean, those who haven't already.
See, if you look across at, our understanding is the RBI's thought process at this point of time is that they want to focus on growth, ensure that the growth cycle continues and we don't see any kind of hiccups there. As far as their inflation projections also go, they don't see any kind of significant shocks on inflation. With this kind of commentary and unless and until we see some shocks on commodity, specifically oil or the global cycle, which is the Fed hiking rates, we believe that RBI will be slow and gradual in rate hikes. With that backdrop, our belief is that negative real rates, because inflation is around 5.5–6%. If you look at, you do more combination of somewhere the true inflation lies between a WPI and CPI, inflation is upwards of 6%. With that case, I think, yes, negative interest rates might continue for a while, but I think probably in the next 6 to 12 months, we would have a proper realignment of rates. Also, we would see the rate hike cycle starting. So I think it is the next three to 6 months near-term problem. On a medium-term perspective, even post 12 months, I think the negative real interest rates would go away.
All right, gentlemen, thanks very much for joining in and talking about, this segment of debt funds. So with that, we'll wind up on MF Corner for now, but do remember that you can always email us your queries and we'll have them addressed with our experts through the week. Thanks very much for watching. Do stay tuned in. Closing bell will take you through the last hour of trade.